Thank you for tuning in to the Behavioral Wealth Consulting Podcast, where our mission is to help you change your behavioral decisions by improving your financial literacy. If you want to live a more fulfilling life and get on track towards your long-term financial goals, it requires changing behaviors, developing a plan, and prioritizing your financial decisions. Now to your host and certified personal finance consultant, Richard Maricut.
Hello and thank you for joining me today. I am your host, Richard Maricut, where my goal is to help you change your behavioral decisions by improving your financial literacy. For today's topic, I'm excited about this one, talking about understanding your credit or improving your credit. Whenever you talk about finances or anything related to money, the topic of credit often comes up, right? Mainly because lenders often use credit score to determine your risk factor, right? So today's topic, we're going to go a little bit more in depth on a variety of things surrounding credit score, how to improve credit, and so forth. Before we get started, just a reminder, I am not a financial advisor. Today's podcast is for educational purposes only. Not intended for any specific financial advice. Always consult with your own financial advisor before making any financial decisions that are based on your situation. So let's get right into it. So, if you're listening to this podcast, you're probably thinking, why listen to me, right? So a little bit about myself. In my early 20s, I made it a point to understand credit. Back then, in the late 90s, early 90s, I remember hearing stories of people that were getting pagers or beepers, getting their accounts in their name for someone else, and then that relationship would go away, break apart, boyfriend and girlfriend would separate, and before you know it, someone's credit was ruined because of an unpaid cell phone or pager a pager bill, right, that went on for months because there was no ownership and didn't understand the impact of it. So, most of the stories that I would hear, boyfriend, girlfriend would break up and someone would stop paying it, and whoever put the account in their name ultimately paid the price. Unfortunately, I remember hearing stories of people 18, 19, 20 years old, suffering greatly and taking years to recover out of a situation like that. But ever since then, I've made it a financial, I've made my decisions based off of, understanding how things would impact my credit score. Most recently, one of my FICO score reports that I received through one of my credit card companies had me at a score of 863, which is the highest score that I've ever seen reported on myself. But we'll spend a little bit more time in today's session talking about score ranges, so you can get a better understanding of what an 863 score actually means. So, what is credit, right? So by the definition, credit is the ability of a customer to obtain goods or services before payment based on the trust that a payment will be made in the future. There's two types of credit scores. There's a generic score, and then there's custom credit score. Generally, in these two types, the generic credit scores are used by many lenders and businesses to determine general credit risk, whereas a custom credit score can be developed by individual lenders. So whether that be your bank, or if you're trying to get a car loan, something like that, each lender can put specific criteria to change the range of the score. Typical scores are up to 850, but they can go up to 900 depending on the specific lender and how they're evaluating someone's risk. Whenever you're talking about a credit score, you're typically going to hear the term FICO score. So what is a FICO score? Or a FICO credit score was created by the Fair Isaac Corporation. So that's what FICO is. It's used in more than 90% of credit decisions made in the U.S. And many lenders actually use a FICO score as kind of their bare minimum to make approvals. So it's kind of a industry standard, so to speak. So whether, again, it's a loan for a car or house, FICO score typically comes into play on your credit worthiness. So what makes up a FICO score? Few different factors, and I'll break these out by percentages. The largest one is payment history, which makes up 35%. This refers to whether an individual pays their credit amounts on time. Then you have the accounts owed, or your utilization, credit utilization. This makes up 30%. This refers to the amount of money an individual owes. And most experts you'll see say that you should have be using less than 30% of your overall limit. Okay. Third one is length of credit history. This makes up about 15% of your score. As a general rule, the longer you have your credit, the better your score, right? Because there's more history that lender could reference your credit worthiness. Number 4 is credit mix. This refers to the variety of accounts. So whether that's credit cards, installment loans like auto or mortgage, that is what a credit mixture is. So again, lenders like to see a variety of different pay options that you have on your report. And then the last one is new credit, which makes up another 10%. This refers to any recently opened accounts. The more accounts that are opened in a short period of time, that can be looked at as a higher risk because, again, as a lender, if they see someone who's trying to open up multiple accounts in a short period of time, that's typically a flag that something might be going on and someone's trying to obtain credit in order to survive, right? So that is a potential flag for lenders. FICO scores and credit scores can be the same thing, but FICO scores also create different products, and other companies can create credit scores. So a credit score is the general name for what is a computer model that analyzes consumer credit reports to determine a score, whereas FICO offers a specific brand of credit score that many lenders use when determining an applicant's credit worthiness, whether it's their payment history, current level of debt, types of credit used, length of credit history, and again, new accounts. But some lenders choose to use their own scoring models or use competitor credit scores in order to, again, make their assessment or evaluation. FICO does this creates their score by using some complex algorithms based on information that is pulled from your credit report. And they will, again, sometimes make the credit more difficult to obtain depending on what you are trying to, or the type of loan that you're trying to get. And in case you didn't know, there are 3 national credit bureaus. Those are TransUnion, Experian, and Equifax. Now, another interesting fact about FICO is that periodically they release new versions of its scores, and it creates different versions of its scores in order to work with each bureau's databases, which is why there are many FICO scores. So if you happen to have, for example, 2 or 3 credit cards that on your mobile app now, you'll often see, check your FICO score for free. And that's because, and if you happen to look at your score from one credit card company to another, you might notice that the score might be off by, 10, 15, maybe even 20 points. That's because each lender, again, may have their own criteria of what they create their score from, and that causes somewhat of that variance. The credit scoring models, they rank the consumer credit behavior. So someone with a higher score is considered less likely to miss a payment than someone with a lower score. And therefore, a higher score can help you sometimes secure better terms or lower interest rates when you're applying for credit. As I mentioned earlier, FICO scores can range from 300 up to 850, which is how they group consumers by credit score ranges. However, one thing to keep in mind is even if they use the same range, the information that a credit report, even if they use the same scoring, their models may take a unique approach with the score. Okay, and keep in mind that lenders can again have their own scoring that may go up as high as 900. However, 850 is typically the norm. 800 to 850 is typically what is considered exceptional. You have 740 to 799 is considered very good. 670 to 739 is considered good. 580 to 669 is considered fair, and 300 to 579 is considered very poor. So, why is credit important, right? And the way I would probably phrase it differently is, what is your credit costing you, right? So not knowing your credit score and what's on your credit report is impacting quite a few things, right? So the first things naturally is if you're trying to get additional credit, not having good credit can prevent that. It also can impact, mortgage, home loans, equity loans, personal loans, business loans, car loans, even car leases. If you're trying to get home or renter's insurance, if you're trying to rent an apartment, and even employment, while you're not able to legally ask someone for their score, they can access your credit reports with written permission according to the Fair Credit Reporting Act. Okay, so keep that in mind. So now that we've talked about what credit is, we'll spend a little time talking about some steps to improve your credit. First is probably the most obvious, but paying your bills on times. This seems simple, yet it's one of the most common reasons for negative impacts to credit. Lenders use payment history as one of the biggest factors when it's considered a good predictor of future performance. So in order to maximize or be consistent with paying your bills on time, you can look at your bank and use tools like automatic payments to make sure that your payments are automatically done without you having to manually transfer funds. The second thing is paying off debt and keeping balances low on credit cards. So credit utilization we talked about earlier, which makes up a big chunk, 30% of your overall score, is definitely another important factor in your calculation. This can be calculated by adding up all your credit card balances at any given time and dividing that by the amount of your total credit limit. Right? So once you do that, you'll see a percentage, and that's credit utilization. So trying to stay under 30% utilization, the lower the number, the better that a lender might see your risk factor being low. Number 3, apply for and open new credit cards accounts only as needed. So, don't apply for accounts just to have a better credit mix. It probably won't improve your overall credit score by opening up accounts that you're not going to use. It may actually harm your credit score by creating too many hard inquiries on your credit report, and hard inquiries remain on your credit report for 2 years. And I'll explain a little bit about hard inquiries and soft inquiries here in a moment. Number 4, don't close unused credit cards. So I know that very early when I first started to open credit or establish credit, I remember paying off one of my first credit cards, and my way of not spending or having the habit of using my card again is not only did I cut up the card, but I closed my account so I wouldn't be tempted to use it. I didn't understand then that closing your account also impacts your available credit, and so if you happen to have limits on other credit cards, it makes your utilization increase, right? So if you want to reward yourself by paying off debt, closing off a credit card, cutting a physical card is a much better approach than closing your account. You never know that when you may need it, and it actually plays in your favor by having an established account with history that it's been paid off rather than closing the physical account. And number 5 is dispute any inaccuracies on your credit report. You should check all 3 credit bureaus at least once a year. And if you didn't know, you could actually go to any of those credit bureaus and get a copy. You're entitled to get 1 free copy per year, so you can actually spread that out. So you may do a TransUnion in January, do an Equifax copy in June, right, and just spread it out through the course of the year, so you can get free copies from each of the credit bureaus 3 times a year if you split it up. And that gives you a way of just doing a pulse check to make sure that you're not a victim of identity theft and someone's opening up credit in your name without you knowing it. All right. And then the last thing I wanted to touch on. So, we've talked about what credit is. We talked about steps to improve your credit score. And if you're in a situation now that you may need help with improving your credit score, you're seeking professional help, just a couple of things I want to go over for you to consider before hiring a credit repair company. You may have seen those signs, a lot of advertisements about, quick credit repair, will improve your score for $99.99, something crazy like that. And it typically, we've all heard this saying, if it seems too good to be true, it probably is. Here are some things to consider before giving money to a credit repair company. A credit repair company rate really depends on the services that you require or are requesting. There can be more of these tailored, comprehensive programs depending on what your circumstance is, but they typically include things like credit bureau monitoring, fraud protection and alerts, score tracking and alerts, so you can be notified when your credit score changes. There's also some score simulators, and that's basically a way for you to understand what an impact to your credit score may be if you happen to get a car loan, or if you want to get a home loan. You can do simulators to determine what that impact could be. And on the reverse side, if you want to see what how your score would be impacted if you start paying off debt, that's what the score simulators can provide. Some credit repair companies also, discuss or provide housing counseling and mortgage lender referrals, ID theft insurance or fraud detection options. They can also provide financial coaching and education. And these packages can often range from $30 to up to $100 a month, again depending on the package that you sign up with and also what you're trying to improve. But before you hire any credit repair company, again, I would recommend that you take a look at your own credit report, which you can get for free. And a couple things to watch out for when you're looking at companies. Are they asking for payments up front before they even start any work? Or if they're even charging for a consultation, right? Number 2, insist that you never contact the credit bureaus yourself. If a company's telling you not to do that, there's probably some flags that should be going up, right? You have every right to reach out to credit bureaus directly. Number 3, if they advise you to dispute information that is accurate on your report. So again, if you had something that impacted your credit score a few years back, and they're trying to help you increase your score by telling you to dispute something that is factual, that's a flag, right? Number 4, they tell you to provide phony information on your application for credit or a loan, right? So if they're giving you guidance that just doesn't seem right or goes against what you should be completing, again, flag. And number 5, they forget to review your legal rights when they explain their services. So again, with these credit card companies, they have to abide by very specific rules, certain things they can and can't do. And if they're not explaining that to you in depth and or providing you the written information that explains what they're providing you or what you will be receiving as their service, again, just be cautious before you give them your money. All right, so that takes us to the end of today's podcast. If you're interested in hearing more similar topics, please visit my website, behavioralwealthconsulting.com. If you're looking for financial coaching, I do offer individual and or group type sessions. Again, if you'd like to hear about any specific topic in future episodes, please email me at behavioralwealthconsulting@gmail.com. We'll love to hear from you, and we'll get a chance to put some topics that you might be interested on future shows. So with that, again, appreciate you joining today's podcast. Take care.
Thanks for listening to the Behavioral Wealth Consulting Podcast. For more information on how we can help you design an effective financial strategy through behavioral changes, visit us at behavioralwealthconsulting.com.